So good afternoon, everybody. Welcome to the July 28th, 2020 edition of Market Matters. It's nice to be back with everybody. For those of you who I haven't met before, my name is Todd Jones. I'm the Director of Investments for Gratus Capital. And I'm glad you could join us for this presentation we'll make today. Following similar formats, let's move to the agenda real quick. Similar as in prior periods, this will be a more traditional Market Matters where we've got no special guests, but a COVID-19 update and some of the updates we're making to our thoughts around that dynamic, economic and investment updates and how those are translating into portfolio changes. And then finally, a topic I've wanted to touch on for quite some time is our renewed enthusiasm for active management. As you all know, we've actually gone through cycles with active management where in some parts of the portfolio we've used indexes, but now are transitioning more towards active strategies, and I'll go into some of those reasons why. Let's turn to the COVID-19 updates, and of course, this is an area that we've seen a lot of change recently. So I like this chart because, or this data series, it's from Bloomberg.com. It's a nice one to reference because it shows you the same data over various regions over time. And as you note here, global case count for COVID-19 after having flattened in the initial stages of this is now rising in a pretty decent clip, most of that being driven by the US, of course, with the hackneyed approach to closures or shutdowns. In addition to the emerging markets, as I mentioned, and early on in the crisis were kind of that next stage of this process where it really hadn't migrated to places like India or Brazil yet, but now it does appear that it's there in full force and it's taking hold in a pretty massive way. So the numbers, do appear a little scary in some of these regions. However, I would say, well, let's before we get to the positives here. U.S. case count, now we're ramping up to total cumulative cases in the U.S. About 4 million. And really what the point of this chart is to show, this comes from USA Today, the Johns Hopkins data series. It's taking shorter and shorter time to reach these million marks as we get further into this crisis. And that does present a risk to our intermediate term economic outlook. Because, let's say there are vaccines being developed, but, efficacy of these vaccines is of variety effectiveness, then, you should expect this to increase at that exponential rate. So how does this all jive with what we're seeing elsewhere? That is, scientific progress, I think, really is what the market is banking on right now to provide a solution for this problem we face in front of us. And that's always been our thesis since the beginning of this, is that, we've got the best minds now fully engaged in finding a solution to this vexing problem. You've got some of the largest companies in the world now dedicating research and development efforts to finding a vaccine or a cure for COVID-19. And, you can see that in some of the rapid acceleration in phase approvals that these drugs are having. So there are, as of yesterday, there were 5 drugs in phase 3 approval, which is the stage right before, vaccines are approved for limited use. And that's important because, one of these could be, a solution to the issue. Now, as Lawrence, one of our analysts, always points out, it's going to be a varying effectiveness because one vaccine could work in some populations and not others. You do have to do a thorough amount of testing in phase 3 across tens of thousands of people to try to control for a number of different variables. So it's not a process that really can be rushed much faster than it typically is. But the good news is that there are some treatments that are on the horizon for some of these situations that we're running into. So, and no one could have predicted how fast we get these, how fast we would have had phase 3 trials for a vaccine. So that's the good news, and I think is what the market is certainly trading off of. Now let's move to the economic and investment updates. So you can see here our investment ratings are still as they were about 2 weeks ago when we were last on. And you can see I'm just reflecting. I'm only going to change this when we make actual changes and reflect the most recent ones we've done. So we made this upgrade to international about a month ago. And the reason that was important was because the reason we thought that was an attractive thing to do was because the US dollar was starting to weaken versus trading partners. And as you might have seen in the news, or maybe not, but the dollar continues to weaken, which is actually putting a nice tailwind under international securities recently, and also under things like the price of gold and precious metals. So we still have, fairly mixed outlook across equity sectors, neutral rating on large cap US for sure, based on valuation. Emerging markets kind of neutral. Developed international is more of a attractive rating, although not extremely attractive. And then the bond side, a lot of things that we are very cautious on the bond side, but neutral on a few areas like high quality corporate bonds and municipal bonds. And then of course on the alternative side, we still find a lot to do in that section of the portfolio. So real asset mix, real assets, commodities, infrastructure, things of that nature have still, I think, are really interesting to look at right now. And also private strategies, as you may know. We've been raising capital for our third private vehicle, which we're seeing really good opportunities for. So just let's turn to some general notes, because this is, I think, an important part of the whole process here to let you know just kind of what's on our mind here. So generally speaking, we are continuing to increase this, what we call dry powder. Dry powder is just an industry term for, short-term cash equivalent. We don't use cash, of course, because cash is earning us zero. So we've decided to use an ultra-short ETF, ultra-short bond ETF that's yielding about 1.5% or 2%. And also market volatility, I think, is here to stay, which is good because it represents an opportunity for those that are patient investors. So as you may recall, we had a significant amount of capital in the ultra-short ETF going into January and February. We liquidated that position to buy stocks on March 13th, and have since, now that the market has recovered back to previous levels that we were back in January and February, we're now raising cash again in this ultra short-term ETF to get ready for what's likely to be really good opportunities into the future as volatility continues to persist. And then, of course, what's the catalyst for that? Well, coming to mind initially would be things like the presidential election. There's likely to be a lot of volatility around that. We are in Q2 earnings season right now, and the good news is, and I think stocks are reflecting this, is that earnings have been better than expected. While they are, showing declines in earnings, generally speaking, year over year, companies are beating the bar, which is, what's important for stock price movements. So the bar was low. Companies are jumping over the bar, which is good. And future quarters, Q3, Q4, will likely be a little more challenging. This has provided some support for the markets. We also are observing, the US dollar continues to fall, and it's a key reason why we find some attractive opportunities on the international side. And just to have it out there, in the ether, our next rebalance points for stocks, this may sound a little silly to talk about it now, but if we get to 3,700 on the upside, we will definitely be rebalancing the accounts. Or if we get down to 2,650 on the downside, we'll be rebalancing accounts, liquidating that ultra short ETF position and adding back to equities. For fixed income, it continues to be similar situation to what we had talked about in March and April, where the Fed is providing a monumental amount of support to the bond market right now. And in that way, yields continue to anticipate more QE. So yields have headed lower and will likely head lower over the intermediate term, probably a short to intermediate term. And that has implications in a lot of different areas, which we can certainly talk about. But one of them is, it actually, as yields go lower, it allows for price to earnings multiples or valuations to trade a little bit higher, because there's a big relative difference now between the attractiveness of stocks, particularly from a yield perspective, and bonds. And so yields go lower. That means we can pay more for stocks into the intermediate term. But it also means we're going to have more volatility. And then on the fixed income side, we're also increasing the higher quality portion of our bond portfolio because we really want that to be the buffer when the markets decide to get really crazy. Generating modest amounts of income, of course, but also providing that liquidity and capital or buffer support for offsetting the equity part of the portfolio. And we continue to find attractive opportunities on the alternative side, particularly for income generation. And that's likely not going to change until dynamics within the fixed income markets change. So this is just kind of a new normal that we're going to have to adapt to. And we'll certainly have more thoughts on this dynamic in the future. So let's turn to the economy real quick, because this is a great index that I have referenced in our market updates with in-person client updates. But what you're seeing here is a picture of the U.S. leading economic indicators. And the leading economic index is something you all know that I track pretty closely because it does have a really good predictive feature to the data set. And what you notice here, starting in April, February and March were basically blackout periods because of the virus really hitting hard initially the U.S. But look at what's happened to most of these indicators as we moved into April, May, and particularly in June. Well, where a lot of these indicators have improved, which is what's giving, I think, the market some confidence that we may have a resolution to this virus at some point in the next 12 to 18 months. So, and of course, I'll go back to my thoughts. The stock market is a discounting mechanism, and that means the stock market is now looking out 12 to 18 months into the future. So we're looking at July, August to November earnings 21 for today's prices. So good news here is, and then of course, housing continues to be a bright spot, which is really interesting. I think most of that has to do with the fact that we've hit all-time low rates in mortgages. Anecdotally, I've gotten offers for a 30-year fixed conforming mortgage, jumbo mortgage, sorry, at 2.5%. That's crazy to think about, but that's also helpful to understanding why housing continues to be a bright spot. It's because people think in terms of monthly payment, not necessarily in total dollar amount per se. But housing being a bright spot is certainly helpful to the recovery. Let's take a look at the equity markets. This is a year-to-date picture of those 4 key indexes that we like to look at. Still, I think the song remains the same here. U.S. large companies continue to lead the most of the rest of the world forward. There has been a big catch-up with emerging market stocks. You can see that happened here in the late June period. That's about the time when the U.S. dollar started to weaken. But interestingly, the small cap index is still down about 12% for the year versus, a plus maybe 1% or so on the S&P. So, as you may know and recall, we still have no exposure to the small company index. And I think that's been really additive because small companies are ones that are not, are hurting the most right now, as most of the government support is being directed particularly at larger companies that employ lots of people. So that's really the only comments I would like to make on this slide. And another comment here just about earnings, which will dovetail into some comments later. But this is a picture. What you're seeing here is so far of the companies that have reported in Q2, of which we've gotten about 50%, I think, have reported so far. This is the outcome of the reports versus what the market expected on June 30th. So about 4 weeks ago. So you can see on average, highlighted here in blue, the S&P was expected to report Q2 earnings on a year-over-year basis down about 42%. I'm sorry, 44%, and today they're down 42%. And the reason I show this is because various sectors are being impacted differently by the virus. So 2 areas that you may recall we've had a very healthy kind of exposure to and are very positive on would be healthcare and information technology. And look at what's happened with those reports. Those have been the two sectors that have had probably the biggest improvement in earnings versus the expectation, 3 or 4 weeks ago. And so that helps to explain partly why the healthcare and IT sectors have done so well this year versus pretty much every other sector. And that's kind of the idea with active management, is to try to identify areas that are likely to do well in the intermediate term and try to avoid those that are likely not to do well in the intermediate term, as exemplified by some of these sectors over here. So I do want to address, maybe some of the valuation concerns that clients have had, because certainly it's something that we are not blind to. That, currently right now the PE on the S&P does not look very attractive, given that earnings have declined on a year-over-year basis. And one statistic I hear a lot right now is, well, it seems like similar to 99, 2000, where the top 5 stocks in the S&P are comprising a larger and larger weighting. And I think this chart actually shows you that's absolutely the case. So 99, 2000, the top 5 stocks in the S&P represented about 18% of the total index. Today, it's much higher. It's at 23%. And concentration in market value has been an important valuation signal in prior periods, but I think it's less meaningful now. And before you roll your eyes and say that's silly, let me just show you the next chart, because I think this shows you why it's not as meaningful as of a metric to get concerned about. And that's this chart right here. So you can see back in 2000, and I reference the same time periods, the reason it's not as big of a problem now, the market concentration, versus what it was back in 2000s, is because the free cash flow generated by the index is now far greater in the top 5, far greater than it was back in 2000. So certainly this dynamic would tip you off that there were problems on the horizon. There were valuation anomalies, because people are valuing a much smaller portion of the cash flow and just basically bidding up companies without fundamental underpinnings. You can see that changed a little bit in 2010 after the financial crisis, but also today, the top 5%, top 5 companies represent 21% of the index, and they also represent 21% of the total free cash flow that's being generated by the index. So the valuation is actually, in my mind, somewhat justified, or at least more palatable than it was back in 2000. Now, of course, there are other valuation metrics that are more concerning, but this is a big one that I hear recently, and I certainly wanted to address that, to say, well, the concentration isn't really that big of a problem, because it makes sense why Microsoft, Amazon, Apple, and Alphabet are all in the top 5 holdings, and more or less 21% of the market right now. It's because they are continuing to consolidate the marketplaces in which they operate. Moving to fixed income briefly, this is a year-to-date picture of a variety of fixed income indexes. You can see the aggregate bond index this year, as yields have gone lower, now to about below 60 basis points, or 0.6 on the 10-year. That's pushed incrementally the bond index up to about 7% for the year. That's a bit unusual, but it also speaks to the fact that when yields get really low, you don't really need a large change in yield to give you a substantial price gain, because of the way the seesaw effect works with bond prices. Yields up, prices down, or yields down, prices up. You can see, interestingly, that emerging markets as well, in this purple line, have really recovered back to their pre-crisis levels. This is, I guess this is good, generally speaking, but it's not something that we find very attractive, because if you can get this type of volatility, meaning down 24, 25% in your bond portfolio, then that's not really a suitable option for what we're seeking within the part of our account that we're looking for capital preservation and income generation. That's really just not appropriate. But it may very well be an opportunity for maybe the alternative section, just not for fixed income. So I just wanted to point out some of the dynamics here. Bond prices have continued to recover which ultimately is good, I think, because it means that anxiety is coming out of the markets. Next, I did want to touch on, before we get to the special topic, there were a few key takeaways here that I did want to reinforce. One is that we are remaining cautious during the recent breakout or breakup, I guess, in stocks, because a lot of the fundamental optimism for the stock prices right now is being built on a foundation of a vaccine being developed and containment of the virus coming to some sort of more stable level at some point in the near future. If those things don't happen, then that would represent a big risk to our outlook, for sure. So I think what does a prudent investor do? They start to get more cautious and they start to raise cash again, which is what we're doing. The U.S. dollar, it continues to remain weak, and I think this underpins many asset category returns right now, which is also underpinning the upgrade on international to a neutral level. And and that's a very powerful dynamic to understand, because we can have positive performance in dollar terms in international stocks, even if the local market returns are negative. And that currency piece is a really underappreciated part of international investing. Q2 earnings have been better than expected, which is a nice surprise. This resilience is assisting equity performance right now, and it also speaks to the fact that some businesses are being more highly valued than others right now, primarily because of consolidating markets and margins rising. But we'll be looking forward to Q3 earnings because the bar will be a little bit higher in Q3, and we'll also be very close to that election time. So interesting, just things to keep an eye out on. And then finally, dovetailing into this cautiousness, we are building back up portfolio resilience to be ready for unforeseen risks. Right now, we're talking about risks that we can identify. I'm sure there are others that are out there that we can't see right now, like a conflict or a Cold War with China, something like that. So it's important to remain cautious, I think, during this time frame, especially with valuations a little bit on the elevated side and volatility likely to be high for the foreseeable future. Let's move to this special topic, because this is a message or a topic that I've been really pounding the table on for probably about a year and a half. And we started converting, particularly for some of our benchmark portfolios, we started converting some of those index exposures into active strategies beginning last year and then on into through the end of the year. And the reason I'm highlighting this as a special topic is because now you're starting to see this thesis play out. And there are a few reasons why active management, I think, is set for a better experience, not only from an asset gathering standpoint, but also from a performance standpoint into the foreseeable future. And here are a few reasons, which I'll touch on in charts in just a moment. But you've got not only high sector, but also stock dispersion, meaning the difference in return between the best performing sector and the worst performing sector is at levels that I haven't seen since the year 2000. So that dispersion provides opportunity. Additionally, and I ran through an example 2 days ago with one of our clients in the banking sector, stock dispersion within sectors is now rising to a level that's almost too good to overlook. So, for example, a new addition to our one of our equity strategies, Morgan Stanley, this year is positive, is up 13% for the year. Bank of America Merrill Lynch, a very similar company in composition, business lines, is down 31%. So plus 13, minus 31. Understanding the differences in how those two companies have performed so differently is really important, I think, to the active management equation. We've also got elevated volatility. I'll show you what I mean by that in just a moment. And then there have been changes in the structure of the financial markets and the equity markets since the financial crisis began in 2009 and 10, which I think are sowing the seeds for better performance. So let's get into what I'm talking about here. So sector dispersion, this is what I'm talking about. And this, what this lists here, this is a year-to-date performance view through, I think it's through last Friday, of each of the S&P sectors. So I'm just going to run through them real quick. This is consumer discretionary, consumer staples, energy, financials, healthcare, industrials, information technology, materials, telecom, utilities, and REITs. And then I added in there just for fun, master limited partnerships. And you can see the difference between the best performing sector, IT, information technology, and energy is over 50 percentage points of difference. And within this differential lies opportunity for astute active managers to allocate to maybe more heavily to IT and discretionary healthcare, and not allocate as heavily to energy, financials, and other things. And that's exactly what we've done in our proprietary strategies, and also within the benchmark allocations that we're making for those accounts that don't have a single stock strategy. So this is a really positive dynamic or a setup for active managers. And if you recall, back in 2017, well, really starting in 2011 or 2010, these bars basically all just about look the same year in and year out, with minor differences. Obviously, it's a gross simplification. But at no point in the last 15, 12 years have these dynamics been as large and as wide. So that's a very positive setup for active managers. The second is volatility levels. So what you're seeing on the chart right now is a graphical depiction of what they call the VIX index, or volatility index. The volatility index is just a rough gauge for the amount of volatility in the market at any one time. The average volatility level over this time period has been 13. So you can see it actually got below that in 2018, 17, popped above it a few times, but really recently we spiked up to this mid 60s and 70s level in March due to COVID, which is similar to that 2008-9 time volatility level. And my only point in showing this chart is that we haven't come down off of these high levels or elevated levels very quickly, which means that there's still a lot of investors out there that are very cautious about what the future may hold, number one. But also number two, there are some catalysts on the horizon that a lot of people can see, particularly around elections, political dynamics, things of that nature. And people are trying to find ways to hedge more actively than they did in the past, just because there's not a lot of belief in the rally currently. But if the average level of the VIX is 13, we're still at 24. That means there's a long way to go down before we get back to normal levels, which is very good for active managers because it gives them opportunities to allocate to stocks when they get temporarily out of whack. So that's a very positive condition, which actually goes hand in hand with that previous slide that I was referring to about dispersion. And then finally, market structure changes. This is a little bit more subtle and a little bit more academic, so bear with me here. But there is a theory out there that passive investing only works because active managers are helping set prices. And at some point, if you get too few active managers, then there's going to be no one out there to set prices. And what happens when there's no one out there to set prices? Well, prices move much larger than they normally would. So you're starting to see that on earnings reports in 2020, where you've got single day moves at all-time highs. I think IBM had, and for a Dow component like IBM to have the biggest move in a day of its share price, same with Boeing and others, I think just speaks to the fact that there is a lot of passive investing right now. So Goldman estimates roughly half the market is passive and half the market is active. We've likely got some more ways to go before we reach that tipping point of max passive exposure. But I think what's happened, and it's important to note, is that as passive is taking over more and more of active exposure, it's providing more opportunities to find value in places that the indexes may be overlooking, or in the volatility that's created in single day moves that might be unprecedented. So this market structure change is really important to note because we obviously consider ourselves to be value seeking. and pretty active. And this dynamic only helps our opportunity set the more passive we get into the market, if that makes sense. And let me just show you an example of what I'm talking about here. So this is a strategy. This is a few lines. The red line is the Morgan Stanley growth portfolio. We added this position to our portfolio, I believe it was back in October of last year, 2019. And we went through a very extensive process internally. This is in our benchmark strategies, in our dividend hybrid strategies, that we have a growth component attached to the strategy. And I think this strategy perfectly exemplifies how you can get really different outcomes than an index. So when we added it, we liked the process. We liked that the ownership of the fund was high within the portfolio management team. We liked some of the moves they were making within the portfolio. We understood why, more importantly, and they were very accessible. And we did a lot of work on this data. One of our analysts did a lot of work on this portfolio. And then when the crisis hit, they pivoted very strongly to work from home themes. And this, by the way, this index is not the S&P. This is the Russell 1000 Growth Index. So this index this year, I think, is up something like 13 or 14% if you were to re-index it to Jan 1. But this particular Morgan Stanley strategy is up, close to, I think, 60% for the year if you were to go back to January 1, primarily because they were very early at identifying the work from home themes were going to be persistent into the future. And so not many people can think that the outcomes could be so different from your index, because if you're outperforming your index or underperforming, you're doing something different by extension. But this, I think, tells you that there are some really talented managers out there. You got to be able to find them, obviously, and allocate to them in size. But this is on the U.S. large cap growth side. One of the positions that we're really proud of, we were able to identify ahead of time, and it's certainly working out for those strategies that has it inside of there. But it's not just limited to the U.S. This is an example of an international position that we added, I believe it was in February 17th, so right before the crisis. We liked, this is the GQG International Opportunity Strategy. This is the International Stock Index. And again, this position would be applied to our benchmark portfolios as well as dividend hybrid portfolios. And what you notice here is, again, significant separation. This is obviously a lot less of separation than the Morgan Stanley, but still 8 percentage points of difference to the positive. We'll take that all day, every day. And I just wanted to show you these two examples because if you can identify those strategies that have talented people running them with high ownership from the portfolio management team that are running concentrated portfolios and best ideas, that have a flexible mandate, that it has a way of working out. And it's certainly working out relative to the benchmark here, but also in other opportunities that we have throughout the portfolio. We want to thank you for taking the time to join us today and let me explain kind of what we're doing within the accounts. Do record all of these webinars and drop them on our website. So for those of you that just dropped in or dropped in maybe halfway through, we'll post that to our website shortly so that you can review it, the whole thing. So I do want to thank you again for your time. We'll see you again in 2 weeks and look forward to the discussion at that point. Thanks.